Well, hi everyone. Shaun Humphries here. Welcome to All Things Retirement. This year's been challenging for investors and retirees. Our dollar isn't going as far as it did a year ago with inflationary pressures and the resulting higher interest rates by central banks. So we've seen rates go up very significantly from where they've been really the last 10 years plus. So we all need a little bit of good news. What's driven the higher interest rates? Of course, supply chain issues, the tragic war in Ukraine causing constraints in energy supply, labor market disruption, the rapid opening of economies as we get into a post-COVID world. So many things have had to be digested by the economy, and it's resulted in very high inflation and the resulting response by central banks. So we could all use a little bit of good news. So I'm going to share one good news story for you in a second. Again, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various wealth planning issues and retirement income planning. And if you need to get a second look at your retirement plan, maybe you're already retired or you're 5 years out from retirement and you'd like to get a plan in place, there's a link in the show notes to our website. You can find out how you can get a complimentary retirement plan. So the screen in front of you has a chart that's put together by RBC and Bloomberg, and it says the finish line for rate hikes appears to be in sight. Expectations are for interest rates to rise roughly 25 basis points to 50 basis points further in 2023. So we are at very low rates through COVID. We're now seeing this acceleration in rates here, but the beginning of the end is getting closer and closer. It's really important that we begin to recognize that, because the longer the bear market or sideways markets go, the higher the likelihood that investors will make knee-jerk response decisions to their portfolios. It's always tough to go through bear markets or challenging markets. And the longer they are, the more likely people will torpedo their investments, even though the investments are high quality, the strategy might be the appropriate one, but the geopolitical events and the uncertainty of the world that's always around us have conspired to negatively impact portfolios. So should the response be to bail? No, it's to be the response that we've had in the past to markets that have been in bear territory and economies that have been struggling. And that's to focus on your portfolio. Do you have quality? Have you been rebalancing systematically? Do you have money set aside, hopefully in reserve for short-term expenses, so you don't have to go into assets to sell at a loss to produce the liquidity and the income that you need? If you've looked after the basics, then you need to be patient. We're getting close to the interest rate peaks, and as those rates begin to come down, you're going to find that markets will respond positively. Not just the stock market, but also the bond market. So the bond market's been challenged this last year as well because of increasing interest rates. As rates peak and then are likely, very likely to come back down the other side, as central banks will likely overshoot the interest rates necessary and rates will begin to come down over the next year or so, you'll see a very positive response on the bond side of your portfolio. So take heart. The end is near likely, and we should see over the next year a better response by capital markets. Anyway, I hope that you found this video helpful. Again, if you're looking for a second opinion on your retirement plan, in the show notes, visit the link to our website to find out how you can get a complimentary plan. And if you like this video, hit like and hit subscribe if you don't want to miss future content. All the best in your ongoing retirement and wealth planning journey. You take care. Bye-bye.